Well, our opinion has not changed, Courtney. We're looking for 2.9% GDP. We're looking for just slightly higher inflation. I think that really what's going on here, you really have to break this down and just to a couple of basic concepts. We're later in the cycle. People get worried about the Fed. They're worried about the Fed possibly making a mistake here, especially after Jay Powell's really enthusiastic economic comments that he made. You know, they're also worried about global growth and, you know, the IMF, not that you want to base your trading on what the IMF is projecting, but the IMF lowered their growth rate for the global economy. So global growth, the Fed, we think those are really two of the biggest risks that are out there, and we've really had some issues with that lately, and I think that's really what sparked the sell-off.
Mike, today is a bit of a quieter day. I guess Bob Pisani said volume is lower, volatility is lower. Markets still mixed. Bonds selling off, though still the yield right now in the 10-year is 3.159. Where do you think we go from here, knowing that the midterm election is also not that far off, so more volatility could be introduced for the market? What's your advice to clients?
Yeah. Well, there's a lot of reasons to be worried, and right, that's part of our job. That's what we do every day is make sure we look at the things that could be a problem. You know, between trading, between higher tariffs rather, between higher interest rates, the elections are coming up, et cetera, et cetera. I mean, I tend to agree with Scott. I think the nuance there is that we've seen the U.S. become more attractive relative to international and emerging markets, and so the U.S. has been the best house in a decent neighborhood for a while. I think it's just become the better house in a lousier neighborhood over the last couple of weeks, and that's probably what's changed about our opinion. Look, I think the way we attack a problem like this, when most folks have made a lot of money in the FANG stocks and in all the corollaries and the baby FANGs and so on. I think the way you think about handling a portfolio here, at least if you have anything longer, any kind of a time frame longer than high frequency trading maybe, or at least a couple of months, is to say, look, let me get rid of the stuff that I'm really not all that happy with, right? Things that I have longer term questions about, and potentially add a little bit to some opportunities that you feel, that your research, that your understanding of these companies has told you to think, hey, I've got a really good next 3 to 5 on this. So that's really how we're thinking about our portfolios. Let's strengthen them. Let's take advantage of some of the weakness, and get the stuff we really want to own.
So, Scott, let me turn back to you. Carl Icahn just a few moments ago say it's time to be cautious in the market. I note that in your note that you say the bull market is not over. But my question is the dominance of the high growth stocks over, and are we turning to a time where value shares may shine?
Ty, I think that what the story is from time to time when you're later in the cycle and there's a little more inflation and a little bit more growth and the Fed's hiking rates, you're going to have some bouts of value outperformance. But I think overall those would be pretty brief. Now, we like financials, but, things like consumer discretionary and technology, those have led the charge, obviously, and growth has dramatically outperformed value. We would argue that the next time growth will perform consistently is probably when you're halfway through the next recession, which we don't see over the course of the next, 15, 18 months. I think that's a low probability. So we would argue that value could outperform here a little bit, but we're leaning still toward growth. We like industrials. We like consumer discretionary. We like healthcare. We also, have been telling our clients we don't want them to get defensive. So things like utilities, we want to lean toward those sectors that are going to benefit, like financials, which I forgot to mention, that are going to benefit from a continuation of this recovery.